It's called wealth scarring, and it affects just about everybody born between 1965 and 1980. In this video, we're going to talk about how wealth scarring affects the finances of Generation X. Coming up next on Holy Schmidt.
Holy Schmidt!
Wealth scarring is a term that came about right after the Great Recession, also known as the Global Financial Crisis, 2008-2009, to describe the permanent financial shocks that happened to people in their early to mid-careers. And it affected everything from earnings to wealth accumulation. If you are approaching retirement, this is a very important video for you to watch. Prior to the global financial crisis, the world was a different place. And a lot of people felt like, well, that really just had a lot to do with the banks. What does that have to do with me? But the fact of the matter is, post the GFC, a lot of rules changed. A lot of things changed, in fact. Everything from compensation to mortgage rates for the better to wealth accumulation for the worse. And all of this affects Generation X. So we're going to talk about the big issues that Gen X is facing now because, frankly, a lot of Gen X is in financial trouble. The first issue is wage growth, and wage growth hasn't kept pace with inflation since the 1990s. Two major recessions disrupted careers. The biggest one was the global financial crisis. And along with that, advancement became much more limited, and lifetime earnings took a hit because if you're not moving up or you're not moving up quickly, well, your opportunity to stay ahead of inflation is pretty limited. Now, was it the Great Recession itself that caused this? No, there were two major headwinds that were created around the time of the global financial crisis. They weren't caused by the global financial crisis, but they were caused around the same time. The first was automation. At that time, the U.S. had gone through the dot-com bubble, but the technology that was developed during that time meant that a lot of jobs could be automated. Around the same time, major outsourcing hubs like Vietnam, India, and the Philippines were improving their quality of work. And so it made economic sense to take a lot of jobs and put them outside of the country if they didn't require real-time interaction with the staff and with customers. If you bought your home in the years leading up to 2008, when the global financial crisis hit, you lost years of equity. A lot of people didn't recover for 5+ years with their home price. Some people just sold. They sold at a loss and they never bought another home. They rented from that point forward. In the same time, the market crashed and people lost a significant amount of value in their 401k. They stopped contributing because they were afraid that they didn't have enough cash flow to live. And so that combination of a drop in the value of their 401k and lack of contribution at what would have been historically low prices meant that people coming out of the global financial crisis were in a precarious position financially. And when housing prices boomeranged back up, they boomeranged hard, and all of a sudden, with the help of a 2 or 3% mortgage, housing prices shot through the roof. So if you didn't own a home at that point in time, you missed the wave. And a lot of people didn't own a home. And the cost of college, not only for Gen X, but for their children, drained their retirement funds even further. And healthcare improvements and corresponding inflation outpaced income and regular inflation in many circumstances. Now let's talk about the retirement shortfall of Gen X. The median retirement balance in their 401k is $151,000. That's barely enough to cover 12 to 15% of Gen X's total spend in retirement. And the amount of time they have left varies, but on average it's 10 years, more or less. And then the big shift, the one that was the huge game changer that everybody thought was going to be a net benefit, became a net negative. And that was the shift from pensions to a 401k. Originally, the 401k wasn't supposed to replace a pension. It was supposed to be in addition to. But with the creation of the 401k, retirement risk moved from the employer to the employee. And then adding to that, early withdrawals, which are pretty common in a 401k, and loans against assets in a 401k further reduce the retirement nest egg. And Gen X was the first full generation to not have access to a pension. The baby boomer generation, at least the beginning stages of the baby boomer generation, generally had access to pensions. As the generations moved on and they got closer and closer to the Gen X generation in terms of when they were born, that started to go away. But a large portion of the baby boomer generation has a pension. So guaranteed lifetime income was replaced with self-funded plans, And a lot of people at that point in time didn't fully understand what a self-funded plan was and how it worked, because it was relatively new for people coming into the workforce. And there wasn't the education level that there is today when it comes to financing your own retirement. Add to that, Generation X is a lot more prone to switch jobs because pensions have a tendency to keep people fixed in one job, one career. But when you don't have a pension and you're jumping from job to job, you also are missing vesting periods within the companies that you move to, or you move to a company that doesn't have a 401k at all. This creates gaps in contributions and lost matches, which means that the overall number keeps going down. And Gen X, also known as the sandwich generation, and not because they like eating sandwiches, but because they're sandwiched between two financial obligations, their parents and their kids, is facing a tremendous amount of pressure. Simultaneous college costs and elder care costs are squeezing household budgets. Time pressures for caregiving slows career progress. A lot of people will take a career break just to care for their elderly parents and or children that need additional attention. And all of this causes chronic stress, which creates mental and physical health issues. And when you look at all of that, it means that many people delay retiring because of family obligations. They have to support their family. 1 in 5 in the Gen X community reports heavy stress. That's more than any other generation before or after Gen X. And there's much more job insecurity now, particularly for those that are approaching retirement, because there's also age discrimination. Someone at the tail end of their career, which might have all of the wisdom necessary to complete many tasks within the organization, is expensive. And with the formula on how to get the maximum income within an organization, one of the first people to go is the person with the most experience and who's most expensive. Older workers are often overlooked for promotions and training because their contribution to the future of the company is limited to fewer years, among other things. And tech-biased stereotypes paint them as less adaptable, but Gen X grew up with analog and they're living in a digital world now. So what happens? During layoffs, higher-paid Generation X employees are the first to go, and once displaced, it's harder for them to find a job, or at least find a job that paid what they were making before. And then there are things that affect just about everybody, particularly mid-career and on. AI has the potential to displace a lot of mid-career employees. And the person born in an analog world where landlines were pretty common, for example, who's now in a digital world, is facing a lot of overwhelm with everything from dealing with the digital aspect of health and health management to banking. Finally, there's an issue with the definition of teamwork. Historically, people worked in teams, but in this day and age, we work in much more of a gig economy. Even if you work for someone else, the younger generation is used to completing tasks, not gathering with other peers to discuss issues. They're given a task, a timeline, and they need to hit the timeline. Everything else beyond that is great, but because of the way the world is now, everything is systematized. And the Gen X employee who could do 2/3 of the job themselves before passing it on is struggling with the fact that they only can do a small piece of it, but a lot more of it is required. Add to that the fact that blunt communication styles can generate friction between generations. And Gen X, who grew up fairly independent in the way that they think, struggles with groupthink, just doing what they're told to do and not questioning why it is being done. And the last point, Gen X is faced with debt overload, something that the previous generations did not have because the world was set up differently. Credit cards, home equity, and student debt leave Gen X with multiple payments. Many Gen Xers refinance their homes to fund college education for their kids and maybe even themselves to some degree, and also fund emergencies, to have a home equity line of credit in place in case there's an emergency. And there's always an emergency. And rising interest rates over the last few years has made things a lot worse because what was a manageable number that they were paying before starts to become unmanageable when you add 2 or 3 or 4% to a 5% payment. And because of medical inflation, access to quality doctors, and some doctors that frankly don't accept insurance but expect you to pay them out of pocket and file with your insurance company, means that credit card debt continues to go up. That's how a lot of people finance medical debt, because they have to have the appropriate amount of medical care. And sometimes it's just not available on plan. And finally, the result. Even if someone is lucky enough to have strong income, Gen X feels like it's one crisis away from financial ruin. Now, what can you do about it? Well, the first is to understand that it's happening, because a lot of times just understanding how the game is being played out in front of you means that you can make small changes to your life to improve your specific situation. If you think you're going to lose your job, for example, make a list of all the recruiters in your industry so you know who they are in case you need to give them a call, or the names of competitors. Talk to friends who work at other companies and see if they're hiring. Keep all of your options open. And that's not just when it comes to your job. Think about things like, where do you keep your money? Are you receiving the appropriate amount of interest in your bank account? Because a lot of banks won't pay you interest unless you ask, believe it or not. When discussing college with your kids, understand the actual dollar amount that you might be contributing and see if there are ways to mitigate that through things like scholarships or in-state tuition. If you're not happy with your health, talk to your doctor. See if you can improve your health. If you're not happy with your doctor, well, look at other doctors on the plan. There are a lot of things that you can do to ensure that you're not paying maximum dollars to get good, sensible health care. And keep asking yourself, is there a better way, a less expensive way to do this? The answer will probably be yes if you spend time thinking about it. And gang, just remember this. You're not a statistic. You're a real person. And if this information makes sense to you, apply some of it or all of it. If it doesn't make sense to you, well then put it on the shelf and look at it later. If you like this video, check out that video, 6 Secrets a Retiree Should Never Disclose. This is Jeff Schmidt, and I will see you in that video right there.